The majority of folks listening have the majority of their assets in pre-tax, 403B, 401k, IRA, right? They think, oh, I have plenty saved. I have $1 million, $2 million bucks. A lot of people never know the tax ramifications. Like if you ask someone how much they have in their IRA, they can probably tell you just off the top of their head. If you ask someone, what are the taxes you'll pay on that in your lifetime? Very few can give you that answer. And so that's Alina has been saying is like the different amount of taxes that we have to look at. If it's a brokerage after-tax account, you look at long-term capital gains, short-term capital gains, dividends, so they qualified or non-qualified, interest, right? If it's a pre-tax account, we're looking at ordinary income. So not only is that taxed at your highest bracket, that adds to your future income when it comes to how much your Medicare Part B costs. And the list goes on and on. So planning is a lot more than just like, yeah, it's a couple things. It's like, if you don't do one thing right, it could impact 3 other areas of your plan.
Absolutely. Also Social Security benefits, right?
Yeah.
Because higher is your taxable income, then at a higher rate, your Social Security benefits can be taxed at the highest 85% of the benefits can be taxed, right?
Yep.
So sometimes it makes sense for some people to take money from their pre-tax accounts at a smaller portions just to spread out that tax liability over some years.
Yeah.
And then combine it with taking money from their taxable accounts like brokerage accounts
Correct.
or cash accounts, Social Security benefits or pension.
And also too, sometimes a lot of our clients, they might take a certain amount out of their pre-tax accounts to get to a certain bracket, but then maybe they take the rest from after-tax or Roth, so it doesn't push them into a higher tax bracket or higher Medicare premiums. If you're listening, right, and you're saying, oh my gosh, I've never even heard of these things, or I haven't done these things, and I've worked hard, saved up a lot of money. You don't want to be that person who's worked up, saved up money, has enough to retire, and either A, takes on too much risk, or B, has no tax efficiency, because tax codes changing is almost as risky, if not more, than the market changing. If tax rates go up, that means you have less when you pull out, which is like losing money in the market every year. So highly recommend if you're in that boat, you saved up more than $1 million, give us a call. We're happy to walk you through that initial consultation.